Imagine standing in a boardroom with floor-to-ceiling windows overlooking a city skyline. The air hums with tension. At the head of the table, a CEO is about to greenlight a billion-dollar deal. The numbers look risky, the markets are unstable, and everyone's watching. For most people, the fear of losing would freeze them. But the top 1%? They lean in. They see what others don't. The hidden edge that turns risk into reward. And that's exactly what we're diving into today.
Let's start with this. Risk isn't reckless. It's engineered. The world's most successful people, investors, founders, and billionaires don't avoid risk. They seek it out, but only when the odds are asymmetric. That means the upside far outweighs the downside. Think about it. Most people fear losses more than they value gains. That fear keeps them small, while the top 1% use frameworks to turn uncertainty into leverage.
And this isn't just theory, it's everywhere. Take Elon Musk betting on SpaceX. He knew rockets cost $65 million each, and most experts said cheaper launches were impossible. But Musk didn't just look at the price, he broke it down. What were the raw materials? What could he rebuild? Using first principles thinking, he slashed launch costs by 95% per kilogram to orbit, transforming the entire industry. Was it risky? Absolutely. But Musk stacked the odds in his favor by eliminating inefficiencies and multiplying upside.
And Musk isn't alone. Jeff Bezos used a similar mindset at Amazon, designing logistics systems not just to speed up deliveries, but to prevent failures. Instead of asking, "How do we win?" Bezos asked, "How do we lose?" Damaged goods, lost inventory, late shipments. Then he reverse-engineered systems to eliminate weak points before they happened. That's the power of inversion thinking, anticipating failure and building defenses before scaling.
And let's not forget Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds. Dalio's entire strategy is built around risk balancing. He doesn't gamble. He diversifies deeply, finding uncorrelated bets that offset losses. The result? Dalio made billions navigating 2008's financial crisis when others crashed. And it wasn't luck, it was systems. He used expected value models and probability-weighted decisions to remove emotion from investing.
And this is where most people go wrong. They think avoiding risk is playing it safe. But the truth? Avoiding risk is the biggest risk. Markets are moving faster than ever. AI is reshaping industries. The economy is shifting. If you're waiting for perfect conditions, you'll never act, and that's what separates the elite. They know calculated risks create growth, while playing it safe leads to stagnation.
So let's break it down. The top 1% aren't fearless, they're strategic. They don't chase every opportunity. They engineer bets where the upside is massive and the downside is controlled. They use frameworks like asymmetric risk and inversion thinking to make sure every move is intentional. And the best part? These systems aren't reserved for billionaires. You can start using them today.
Before we dive deeper into asymmetric risk frameworks and decision systems in the next segment, make sure you subscribe on Spotify and Apple Podcasts so you never miss an episode. And if you want even more insights, follow us on Twitter at @FinFrontierAI. Now let's unlock how the top 1% stack the odds in their favor.
We've talked about how the top 1% approach risk strategically, but now let's go deeper. How do billionaires make bets that seem risky but end up paying off massively? The answer lies in something called asymmetric risk. It's a framework for creating scenarios where the potential upside far outweighs the downside. And it's how the elite consistently turns small bets into big wins.
Let's break it down. Asymmetric risk is all about low-risk, high-reward moves. Imagine risking $1,000 for a chance to make $100,000. Even if you lose 9 out of 10 times, one win wipes out the losses and delivers a huge profit. Billionaires love this approach because it shifts risk from certainty to probability. Instead of betting the house, they bet strategically, stacking small risks where the rewards are exponential.
Take Peter Thiel, for example. He invested $500,000 in Facebook when it was just a college startup. Most people saw it as a long shot. Thiel, he saw asymmetric potential. His downside was capped at $500,000, but his upside? Billions. He didn't bet randomly. He looked at the network effects and growth potential, calculated the risk-reward ratio, and doubled down. That's the mindset. Bet small, scale big.
And this isn't just for tech investors. Look at venture capital firms. They build entire portfolios around asymmetric risk. They know most startups fail, but one or two big wins can deliver 10x or even 100x returns. And they don't wait for perfection. They test small ideas, track performance, and scale what works. The lesson? Test small bets first, then scale success.
But let's go further. How do you spot asymmetric opportunities? First, you calculate something called expected value, EV. It's simple. Multiply the probability of success by the potential reward and compare it to the risk of failure. For example, if there's a 20% chance of making $100,000 and a 5% chance of losing $10,000, the EV is positive and the risk is worth taking. The 1% run these numbers constantly. They never bet blind, they bet calculated.
And here's where most people go wrong. They focus too much on certainty instead of probability. Billionaires don't ask what's guaranteed. They ask what's possible and what's the price of missing it. Take Jeff Bezos and his decision to start Amazon. He called it his regret minimization framework. Bezos didn't just focus on the odds of failure. He focused on the cost of not trying. The downside? Losing a stable job. The upside? Building a company that could change the world. And we know how that turned out.
And it's not just business. Asymmetric risk applies to your time, skills, and connections. Think about investing 10 hours in learning AI tools or building a network on LinkedIn. The risk? A little wasted time. The upside? New opportunities, job offers, or breakthroughs that wouldn't exist otherwise. The 1% know it's not about playing it safe. It's about multiplying bets that others overlook.
And AI tools make this even easier. Platforms like AlphaLens and Monte Carlo simulations let investors model thousands of possible outcomes, testing risk before they commit real money. Hedge funds like Bridgewater Associates use these systems to predict scenarios and balance portfolios. The result? Fewer surprises and smarter moves. This is how billionaires remove emotions from risk-taking and make data-driven decisions.
And here's where it gets interesting. Asymmetric risk isn't just about money. It's about time, energy, and effort. Ask yourself, what's the smallest action you can take today that could create massive results later? Maybe it's reaching out to a potential client, pitching an idea, or launching a side hustle. The risk is low, but the upside? Unlimited.
So let's recap. Asymmetric risk isn't gambling, it's engineering opportunities where rewards crush risks. Start small, test ideas, and scale success. Use tools like AlphaLens and AI simulations to run the numbers and let data guide your bets. In the next segment, we'll dive into second-order thinking, how billionaires predict ripple effects and outthink the competition. Let's keep building.
So far, we've covered asymmetric risk and how the top 1% create massive upside with minimal downside. But that's just one layer of how the elite think. The next layer? Second-order thinking. It's the ability to look beyond the first consequence of a decision and predict what happens next and what happens after that. Billionaires don't just ask, what's the result of this move? They ask, what ripple effects will this decision create? And that's how they avoid pitfalls and spot opportunities others miss.
Let's break it down. First-order thinking is linear. It focuses only on the immediate outcome. For example, you might think if I cut costs, my profits will increase. But second-order thinking digs deeper. What happens if I cut costs? Will product quality drop? Will customer satisfaction fall? Will long-term sales suffer? The elite always ask, and then what? Because that's where the real risks and rewards hide.
Take Netflix, for example. When Blockbuster was focused on short-term profits from late fees, Netflix asked, what's next? They saw the rise of streaming before anyone else and invested early, even when the technology wasn't perfect. Blockbuster? They doubled down on stores and late fees, and by the time they realized their mistake, it was too late. That's second-order thinking in action, spotting shifts before they become obvious.
And it's not just Netflix. Look at Tesla. Elon Musk didn't just see electric vehicles as a trend, he saw the entire ecosystem shifting. He predicted the rise of battery technology, renewable energy storage, and autonomous driving. By building Tesla's infrastructure early, he wasn't just selling cars, he was positioning Tesla as the backbone of the future energy economy. Second-order thinking turned Tesla into a trillion-dollar company, and it's still scaling.
And this mindset isn't just for companies. Think about investing. Most people ask, will this stock go up? The elite ask, what happens next if it does? Will competitors respond? Will regulations tighten? Will the trend accelerate or collapse? This is why hedge funds and billionaires model multiple scenarios before making moves. They don't bet on outcomes. They bet on chains of events.
And AI is supercharging this process. Tools like Crystal AI and Scenarios 360 simulate thousands of outcomes, testing every variable. For example, an investor might model how interest rate hikes affect housing markets, which then impacts construction companies, mortgage lenders, and REITs. These simulations allow billionaires to see hidden opportunities and risks that others miss.
And here's the real secret. Second-order thinking eliminates guesswork. While others react emotionally to headlines, the 1% prepare before the headlines happen. Think about Ray Dalio's approach at Bridgewater Associates. He maps scenarios years in advance, analyzing how geopolitical shifts or economic policies ripple through global markets. That's how he navigated the 2008 crisis while others collapsed. It wasn't luck, it was systems.
So how do you start using second-order thinking? Begin with this question, and then what? Let's say you're launching a new product. Ask yourself, what happens if it succeeds? Can we scale fast enough? What happens if competitors copy us? How do we defend market share? By thinking multiple steps ahead, you'll avoid surprises and stay ahead of the curve.
And don't stop there. Use AI tools like Scenarios 360 to model possibilities or even run worst-case scenarios. Ask yourself, what could derail this plan? What am I not seeing? Then test, track, and refine your assumptions as you go. The top 1% don't predict the future. They prepare for it. And that's what second-order thinking is all about.
Let's recap. Second-order thinking goes beyond obvious results. It predicts ripple effects and hidden consequences. It's how Netflix beat Blockbuster, how Tesla built an energy empire, and how hedge funds like Bridgewater stay ahead of global trends. Use it to ask. And then what? Model outcomes with tools like Crystal.ai and prepare for opportunities before they happen. In the next segment, we'll dive into risk psychology, the emotional frameworks billionaires use to stay calm, focused, and bold when others panic. Let's keep going.
We've covered how billionaires engineer risk and think multiple moves ahead, but now let's talk about something even more powerful, risk psychology. Because here's the truth, your mind can be your greatest asset or your biggest enemy when it comes to risk-taking. Fear paralyzes most people, while greed blinds others. But the top 1%? They've trained themselves to master emotions, and that's what sets them apart.
Let's start with fear, the silent killer of big opportunities. Studies show that humans experience loss aversion, the pain of losing, twice as intensely as the pleasure of winning. It's why most people hold on to losing stocks for too long or refuse to take a profitable risk because they're too focused on what could go wrong. But billionaires flip the script. Instead of focusing on losses, they ask, what's the cost of doing nothing? That shift turns fear into fuel.
Take Jeff Bezos' regret minimization framework. Before starting Amazon, Bezos asked himself, when I'm 80, will I regret not taking this chance? That single question reframed the risk, not as a potential loss, but as a potential regret. And it's a powerful tool for anyone struggling with fear. Instead of asking, what if I fail? Ask, what if I don't even try? The top 1% aren't fearless. They just fear staying stagnant more than taking action.
And then there's greed, the other extreme. Greed pushes people to chase big wins without thinking through the risks. That's why most lottery winners go broke and why bubbles burst when people get blinded by hype. The top 1% don't let greed drive their decisions. Instead, they use data and discipline to create systems that keep emotions in check. Look at Ray Dalio. His hedge fund relies on algorithms and AI modeling to remove emotion entirely and make decisions based purely on probabilities.
And speaking of systems, let's talk about emotional journaling. Billionaires don't just track numbers, they track their emotional responses to risk. They document when fear made them hesitate or when greed made them reckless. Tools like Mood Notes and Cinti One now use AI sentiment tracking to analyze emotional patterns. Imagine being able to see exactly when your emotions are hijacking your decisions and course correcting in real time.
But that's just the beginning. The elite also train mental resilience through frameworks like Stoicism, embracing discomfort to prepare for uncertainty. Think about Tim Ferriss' fear-setting exercise. Instead of avoiding fear, he writes down the worst-case scenario, lists how to recover from it, and breaks it down until it no longer feels overwhelming. The result? Fear loses its power and decisions become clearer.
And let's not forget visualization. Billionaires don't just plan for success, they mentally rehearse it. Athletes call this mental priming, seeing yourself win before it happens. Studies show that visualizing success can increase performance by up to 23%. Tools like Prime Mind and BetterUp use AI to guide visualization exercises, building confidence and focus for big moments.
And here's where it all connects. The top 1% combine fear management, emotional tracking, and visualization systems to make bold decisions without losing focus. They don't suppress emotions. They use them as signals. Fear means pay attention. Greed means slow down. And by staying emotionally aware, they take risks most people avoid and win when others panic.
Let's recap. Fear is a tool, not a trap. Use frameworks like Bezos' regret minimization and Tim Ferriss' fear setting to reframe decisions. Track your emotions with AI tools like Cinti One to remove bias, and practice visualization techniques to build mental toughness. In the next segment, we're scaling up how billionaires turn small bets into big wins without losing focus. Let's keep going. We've talked about taking risks, managing emotions, and predicting ripple effects. But now let's talk about scaling bets. Because here's the truth, the top 1% don't start with massive moves. They start small. They test. They learn. And then they scale fast. That's how they win big without betting everything on a single roll of the dice.
Let's start with the concept of the minimum viable product (MVP). It's the strategy behind companies like Airbnb and Dropbox. They didn't launch billion-dollar businesses overnight. Airbnb started with air mattresses in a spare room, and Dropbox began with a simple demo video before even building the product. Why? Because the MVP approach lets you test an idea with low risk before going all in. It's risk reduction, proof before scale.
And this approach applies to investing too. Look at angel investors like Naval Ravikant. He doesn't throw everything at one company. He invests small amounts in dozens of startups. He knows most will fail, but one success can return 100x or even 1,000x the original investment. The lesson? Diversify small bets and let the winners run. It's all about stacking the odds in your favor.
And let's not forget iteration cycles. Billionaires don't just test ideas, they improve them quickly. Look at SpaceX. Musk didn't build the perfect rocket on day one. He built prototypes, launched tests, and fixed failures until Falcon 9 became the world's first reusable rocket. Instead of waiting for perfection, he scaled step by step. This approach, launch, learn, and refine, is what separates fast movers from people who never start.
And tools make this even easier. AI-powered platforms like Airtable let teams track experiments, while tools like Zapier automate repetitive tasks so you can scale faster. Imagine testing 10 small marketing campaigns, tracking results in real time, and automatically scaling the best performing one. That's how billionaires think. They use systems to amplify wins and cut losses fast.
And speaking of cutting losses, billionaires don't just scale up winners, they kill bad bets quickly. It's called the fail fast framework. Instead of wasting time defending bad decisions, they pivot or walk away. Take Jeff Bezos. Amazon experimented with the Fire Phone and it failed. But instead of sinking more money into it, Bezos shut it down and redirected resources into Alexa and AWS, which became billion-dollar businesses. The lesson? Fail fast, move forward.
And here's where scaling bets gets even more powerful: compounding effects. The top 1% don't just make one bet, they stack bets. Imagine building a habit of testing one idea a week, improving results by just 1% per test. Over a year, that's not 52% growth, it's 67% growth because results compound over time. This is how billionaires scale, small wins that multiply.
And let's recap. Scaling bets is about starting small, testing fast, and doubling down on what works. Use frameworks like MVP testing to prove ideas. Track results with tools like Airtable and automate decisions with Zapier. Learn from failures like Amazon's Fire Phone and pivot fast when needed. And most importantly, stack bets that compound over time. In the next and the final segment, we'll pull everything together and give you the exact steps to start thinking and winning like the top 1%. Let's finish strong.
We've uncovered the mental frameworks, risk strategies, and scaling systems that set the top 1% apart. But here's the reality: information alone isn't enough. Success doesn't come from knowing what to do, it comes from doing it. And this final segment is all about taking action, turning what you've learned into results.
Let's start with what we covered. First, we broke down asymmetric risk, how the elite stack the odds by limiting downside and maximizing upside. We talked about Peter Thiel's $500,000 bet on Facebook, where the risk was tiny but the reward was billions. And we introduced tools like Alpha Lens and Monte Carlo simulations to model risk before taking action. That's your first takeaway: small bets, big wins.
Then we layered in second-order thinking. We showed how billionaires like Elon Musk and Reed Hastings don't just look at the first result of a decision, they predict the ripple effects. It's how Netflix saw the streaming revolution coming, and how Tesla positioned itself as the backbone of a future energy economy. The key question? And then what? Keep asking it, and you'll always stay one move ahead.
Next, we dove into risk psychology, the emotional side of risk. We talked about Bezos' regret minimization framework and Tim Ferriss' fear-setting exercise, tools that billionaires use to turn fear into action. And we explored AI tools like SentiOne for tracking emotional patterns, removing fear and greed from decisions. Remember, risk isn't just about numbers. It's about mental resilience and learning to trust the process.
And finally, we explored scaling bets. We showed how billionaires start small, using MVP testing like Airbnb, and scale what works. We talked about iteration cycles, compounding gains, and tools like Airtable and Zapier to automate growth. The lesson? Don't aim for perfect, aim for progress. Fail fast, learn faster, and keep stacking wins.
Now it's your turn. Look back at the frameworks we covered: asymmetric risk, second-order thinking, risk psychology, and scaling bets. Pick one strategy this week. Maybe it's building a new habit of asking, and then what? Maybe it's testing an idea with MVP thinking. Or maybe it's simply journaling your emotions before a big decision. Start small, but start now.
And before we wrap up, make sure you subscribe on Spotify and Apple Podcasts so you never miss an episode. And follow us on Twitter for more insights, frameworks, and tools to keep scaling your success. Thanks for listening, and we'll see you next time as we keep exploring the mindsets and strategies of the world's most successful thinkers.
And one last thing, music disclaimer. The intro and outro music, Dreaming On Instrumental by Netflix, is licensed under the YouTube Audio Library license. Full details can be found in the episode description.
We do it now.